the markets tend to do that, though. That's the natural response, is to move on any kind of news. The economy is certainly in very good health right now. When you look at unemployment rate as low as it is, you look at business confidence is second highest level it's been since 1983. You look at government spending is now a boost to growth. You look at the global economy, and it's stronger than it has been. And so certainly the economy is in a good shape right now, and things are firing on all cylinders.
You know, if you go to the majority of the major newspapers and news sites across the country, Craig, as I'm sure you do every day, you start to see basically, here, let me give you a summation of the headlines. Trump, 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 Trump. How much of that is sort of eating the news cycle where American consumers are not being exposed to a lot of really positive stories out there that they should be?
Well, that's certainly on a political level. I think that's the focus is Trump and the various headlines that come out of the administration. You're absolutely right. When you look at the broader economy, though, the headlines are very strong. They're probably being replaced by some of the more emotional headlines, some of the more extravagant things. And so, yeah, I agree. I mean, I think the newspapers are probably missing some of the bigger news, which is that the economy is as strong as it's been in a long time, and probably stronger than is what is sustainable longer term.
All right, the yield curve. I know it's early, Craig, so it's a little bit hard to talk about this, but it is important, and that's why we highlighted it right at the top of the show. The 10-year yield still about 20 basis points higher than the 2-year. If we see short-term rates go above longer-term rates, if we get that inversion that people talk about, to you, does that automatically signal either a slowdown or a recession is coming?
So it's not automatic. There's a couple of caveats to it, but absolutely, you know, we heard Powell talk about it in his testimony before the House and Senate committees. We heard Kudlow talk about it yesterday at the conference. It is something that we're watching very closely, because when the 2-year and the 10-year inverts, historically, it means that you're nearing the end of the economic cycle. And I'd give you one caveat. If you go back to over the modern Fed era, it's inverted 4 times, preceding the three recessions. The one time that it inverted, where we didn't see a recession follow up from that, was in 1998, and it was when you had the Asian financial crisis going on, you had long-term capital fail, you had the Russian ruble crisis, and so you had longer yields pushing lower, and that caused the curve to invert because of the flight to quality. In every other scenario, the Fed was hiking rates actively, and they hiked rates above where longer yields were, which created financial conditions that were tighter than what the market thought the economy could handle. And so when that scenario unfolds, which is the scenario we're in right now, frankly, then I think it is a leading indicator that we're near the end of the economic cycle. It can take a while to play out. It's taken up to 24 months to play out. But certainly I think that would be an indicator that we're near the end of the economic cycle.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.